Have you ever looked at a company's, their financial headlines, maybe their net profit, and just felt like you were getting a snapshot? Not really the whole movie.
Yeah, like just one scene.
Exactly. And you wonder, what if there are these other really crucial pieces of the financial puzzle, maybe sort of hidden, that could, well, completely change how you understand that company's real health?
It happens all the time. The headline number doesn't always tell the full story.
Well, today we're doing a deep dive into something absolutely essential for getting that fuller story: comprehensive income.
Ah, yes. Very important.
Our mission here is to pretty quickly but thoroughly get you up to speed on this: what it is, what makes it up, how it's reported, and really why it matters so much for anyone looking at financial statements.
Whether you're studying for the CPA, you're an accounting student, or already out there in finance, it's key.
We want to unlock those insights that often get, well, overlooked. Now, before we really jump in, just a quick reminder: this deep dive is based on material from Farhat lectures.
Great stuff over there.
Absolutely. All the content, examples, the explanations we'll talk about, they're derived from the comprehensive accounting resources you can find at farhatlectures.com.
Mm.
So whether you're that accounting student, a CPA candidate, or a professional, you should definitely visit the website for more practice questions, video lectures, and just detailed support to help cement what we cover today.
Really valuable resources.
And a special thanks to Professor Farhat for providing this material for us to discuss.
Indeed.
Okay, so let's unpack this. Comprehensive income. What is it really at its core?
Well, fundamentally, it's defined as all the changes in a company's equity during a period.
All changes.
Right, except for two specific things: direct investments by the owners, like buying more stock, and distributions back to the owners, like dividends, everything else that changes equity. That's comprehensive income.
So it's aiming for that much more complete, sort of holistic view compared to just the net income figure we usually see.
Precisely. That's what's fascinating here, that holistic perspective. It really broadens the scope beyond just, the profit from selling widgets or services.
Mm-hmm.
It acknowledges that a company's equity, its net worth, essentially, can be affected by all sorts of economic events that aren't part of the regular day-to-day business, but are still really important.
Like painting the whole landscape, not just the main factory building.
Exactly. A perfect analogy.
Okay, so if it's this broader landscape, how does it actually get built? What are the pieces? It's not just one number that pops up. Right?
No, that's a great point. It's basically built on two main pillars. First, you have the familiar net income.
The bottom line of the income statement.
The very same. Profit or loss from your regular activities, revenues, expenses, gains, losses, the number used for earnings per share, all that.
Okay, pillar one.
Pillar two is what we call other comprehensive income, or OCI.
OCI, right. And this is where things get interesting, I think.
This is where it gets really interesting, because these are the items that do affect equity. They change a company's net assets, but they are specifically excluded from the net income calculation.
Why exclude them if they affect equity?
Because they haven't really been realized through normal operations yet. Think of them as reflecting economic events that have an impact, but maybe the final cash effect or transaction hasn't fully settled. They're sort of in-progress impacts, but definitely real changes to equity.
So not operational profit, but still a real economic change hitting the balance sheet, essentially.
You got it. They reflect shifts in value or exposures that matter.
Can you give us some concrete examples? What kind of things fall into this OCI bucket?
Sure. Some common ones you'll see are unrealized gains or losses on certain types of investments, specifically available for sale securities.
Okay, investments they might sell but haven't yet.
Right. Also, foreign currency translation adjustments. If a company has operations overseas, the value of those assets and liabilities shifts as exchange rates move. That gain or loss often goes into OCI.
Ah, that makes sense. Exchange rate fluctuations.
And another big one can be adjustments related to pension plans, certain actuarial gains or losses that arise from changes in assumptions about future obligations.
Wow.
Okay.
So these are definitely not minor things. They sound like they could have significant impacts. These are those hidden impacts you mentioned.
They can be very significant, yes. And they directly affect the company's overall financial position, its equity, even though they bypass the traditional net income calculation.
So given that we have net income and then these other OCI items, how do companies actually show this combined comprehensive income to us? How's it presented?
There are basically two allowed ways under accounting standards, like US GAAP and IFRS.
Okay.
Option one, a company can present a completely separate statement, called the Statement of Comprehensive Income. It usually starts with net income and then details the OCI items to arrive at total comprehensive income.
A dedicated statement.
Option 2, they can combine it. They present a single, continuous statement of income and comprehensive income. So you'll see the regular income statement down to net income, and then immediately following that, the OCI section leading to total comprehensive income.
One long statement. But in both cases, net income is clearly separated from the OCI stuff.
Absolutely critical. That separation is key. This raises an important point. Why insist on that separation?
Yeah, why?
It allows analysts, investors, anyone using the statements to clearly distinguish. You can see the performance from the core operations, that's net income, and then separately see the impact of these other, often more volatile or non-operational equity changes in OCI.
So you can analyze both parts without them getting jumbled together. Assess operational strength versus, say, market fluctuations affecting investments.
Precisely. You get both perspectives clearly delineated.
Okay, that distinction makes a lot of sense. Let's maybe bring this to life with a simple example, just to see the numbers flow.
Good idea. Examples always help.
All right, imagine a company. For the year, their net income, calculated the usual way, is $100,000.
Okay, solid profit.
But during that same year, they also had an unrealized gain on some available for sale securities amounting to $10,000. Maybe the market value went up. And let's say they also had a foreign currency translation loss of $5,000 because the dollar strengthened against a currency they operate in.
Okay, so a positive OCI item and a negative one.
Exactly. And remember, these OCI items, the $10,000 gain and the $5,000 loss, they aren't in that $100,000 net income figure.
Correct. They happened, they affected equity, but they live in OCI land.
So how would the statement of comprehensive income look, simplified?
Okay, simple version. You'd start with net income, $100,000.
Got it.
Then you'd have a section maybe called Other Comprehensive Income. Underneath that, you list the items. Unrealized gain on investments, $10,000. Foreign currency translation loss, $5,000. You show losses in parentheses or as negative. Then you subtotal those OCI items. So $10,000 minus $5,000 gives you total other comprehensive income of $5,000 positive.
Okay, the net effect of OCI was positive $5K.
Exactly. And then the final step, you add the net income to the total other comprehensive income. So $100,000 plus $5,000 equals total comprehensive income of $105,000.
Ah, okay. So while the net income was $100K, the total change in equity before owner transactions was actually $105K.
That's it. The comprehensive income gives you that broader measure of the overall change in wealth or equity for the period.
That example makes it really clear. It's not just a small difference here. It shows how looking only at net income, $100, might miss that extra $5K positive impact on the company's overall equity position in this case. Or it could easily be a negative impact in other scenarios.
Absolutely. It shifts the picture. It forces you to consider not just operational results, but also how the company is navigating wider economic forces like market movements or currency shifts.
So let's really put them head to head then. Net income versus comprehensive income. What's the bottom line on what each tells us?
Okay. Net income, still incredibly important, don't get me wrong. It's your best measure for short-term profitability from the core business. It's what drives earnings per share, which investors watch like hawks. It tells you, did the company make money doing its main thing this period? It's the operational report card.
The daily grade?
Kind of, yeah, but comprehensive income. That gives you the vital additional context. It captures those financial impacts, those real economic changes that aren't flowing through net income yet, or maybe ever in some cases, but still affect the company's value.
So it's the full semester grade, maybe, including factors beyond just the daily quizzes.
That's a good way to think about it. It gives stakeholders, investors, creditors, management, a fuller, more complete picture of the company's overall financial health and performance, especially thinking longer term.
It connects to that bigger picture, seeing the whole financial story.
Right. If net income is the snapshot of operating performance, comprehensive income is trying to be the entire financial movie for the period, including those background economic shifts, market changes, currency effects, things that really shape the company's long-term path and risk profile. That's crucial for deeper analysis and strategic thinking.
That snapshot versus full movie analogy really sticks.
Okay.
So, thinking about our listeners, especially those maybe studying for the CPA exam or students really trying to get a deep grasp, why is understanding comprehensive income particularly relevant for you? Why should you really care about this distinction?
Oh, it's critical for several reasons, especially if you're heading towards the CPA or serious financial analysis. First, it directly tests your understanding of equity. How does equity change beyond just retained earnings from net income? Comprehensive income is central to that.
Test deeper knowledge.
Exactly. Second, it shows you can analyze longer-term financial effects. Things like unrealized gains, losses, or currency impacts might not affect this quarter's profit much, but they signal potential future volatility or value changes. Crucial for valuation, for equity analysis, understanding risk.
Seeing around the corner a bit.
Precisely. And third, it really strengthens your grasp of how the financial statements all link together. You see items impacting the balance sheet, equity, that aren't on the traditional income statement, and you understand why based on reporting standards. It's about seeing the whole integrated financial reporting system.
It connects the dots across statements.
Perfectly put.
So really, at the end of the day, comprehensive income isn't just some accounting box-ticking exercise. It's genuinely a powerful tool for getting more insightful analysis, right? For making better decisions. It lets you peer beneath that surface-level net income number.
Absolutely. Understanding the nuances, the difference between net income and comprehensive income, it sharpens your analytical skills. It means you can make more informed, more robust judgments about a company's real financial health, its true performance, and maybe avoid some hidden risks.
So here's a final thought to leave you with. Consider how often, maybe in the past, you've primarily focused just on that net income figure.
Which many people do.
Right. What vital pieces of a company's financial story, these OCI items we talked about, might you have been missing? Think about that tech company example. Maybe great net income, but a huge unrealized currency loss lurking in OCI signaling trouble ahead. Or the opposite, a hidden cushion from investment gains. How could really understanding comprehensive income change your next investment decision or your next piece of business analysis? It's something worth pondering.
Definitely food for thought.
And of course, we encourage you to keep exploring, keep building your accounting knowledge. Don't forget to check out those comprehensive resources we mentioned earlier over at Farhat Lectures to really solidify these concepts.